Down 1.7% here, loss of 37 points or so. Apple shares are just getting hammered this morning.
We're down by between 3 and 4.5% generally across these markets. Let's talk about the speed with which we are watching this market deteriorate. We read everywhere, essentially, down by 4-5%. We're down over 16%. Dow at the same time has fallen about 18%.
So that was a video from 2008-2009 era. And today, which is July 24th, we actually had the worst day in NASDAQ and S&P 500 since 2022. And if you look over here, NASDAQ today is down more than 3.5%, and S&P 500 is down 2.3%. Now, is this the beginning of a new recession? I don't know, and I cannot tell you. However, what I want to talk about today is how you can hedge against the recession using dividend stocks. Before we begin, I want to ask you for a quick personal favor. Please smash that like button if you enjoyed this video and subscribe to this channel if you want to see more videos like this. This would really help us on YouTube so that YouTube can show us our videos to more people. With that said, let's begin. During the great financial crisis, the S&P 500 dropped from the top in 2007 to the bottom in 2009 by as much as 60%. However, if you owned a dividend stocks portfolio, you could afford to not sell your shares in your stocks at a huge loss. You could survive on or supplement your income with the dividends that you collected from your dividend stocks, and that would help you survive the recession and come out on top once the market realized that maybe it's not so bad and all the stocks went up with the economy. So if you were in the market, or if you had a 401k back in 2008-2009 recession, great financial crisis, then you probably remember headlines like people lost half of their retirement, people lost 70% of their retirement. And in a way that was true, but at the same time, that was a paper loss. So if you didn't sell, then you didn't lose anything. Yes, it was really painful to watch your portfolio down by 60%, and I want to show you that. So if we look at lifetime of the SPY is an S&P 500 ETF. You can see over here at the peak of 2007, so in October, SPY was at 155, so that equates to 1550 points on S&P 500, and then less than 2 years later it dropped below 70 or 700 on the S&P 500, and that was during March of 2009. And then it took it about 6 years to recover to the same level as it hit in October of 2007. So by April 2013, it went back to 155. So that's almost 6 years. That's a very long time to be down on your retirement, on your investments. Now, individual stocks did better. However, overall, if you were, say, in SPY or some similar mutual fund or ETF, then it was really painful 6 years of down market. Now, if you did buy in the spring of 2009, you were doing great because market has recovered tremendously. However, if we look at the dividends of the S&P 500 companies, now remember the peak was in 2007, so right over here, so October, and this is September dividend for the SPY, it was 71.9 cents. And then while the market crashed more than 60%, or the S&P 500 crashed more than 60%, at the lowest point, so this is already 2010, the S&P 500 dividend from the SPY ETF was 48 cents. So it did go down, but it went down nowhere near 50%, maybe 30% from the peak. Okay, and this just shows you that dividends, unlike share prices, they are a lot more resilient to the market crashes. And keep in mind, great financial crisis was a really bad recession. It wasn't a small time recession, it was huge. Now if you look over here, 2001 crisis barely budged the dividends. I mean, 2000, the dot-com barely changed the dividends on the SPY. And so this basically shows you that if you have a dividend stocks portfolio, you are more immune to the market crashes than if you were in purely stocks, especially growth stocks. Those crash even harder than, the regular companies. And so to illustrate this point, I'll show you a few companies from S&P 500 list. So these are the companies sorted by the highest yield going forward. And so I'm not going to use Walgreens because that's just a horrible example. So MO, Altria, also not a great example because right around great financial crisis, they actually split off with the Philip Morris Corporation. And that basically affected their dividends. So we can't really judge. But even so, like over here, this was the lowest dividend of that time. So right before the great financial collapse began, meaning the stock market, you can see even during the great financial crisis, they actually raised the dividends all along. So they actually never cut them. And over here, this is the split off with Philip Morris International. So they didn't cut the dividend, they reduced it because shareholders of Altria received shares in Philip Morris. And this year's Kraft Foods also got spun off. So anyway, Altria raised their dividends all through the great financial crisis. Now, I'm not advocating that you buy Altria. In fact, I just sold my Altria stocks because I think the shares ran up way too high in basically 4 months. If you look over here, they ran from below $40 to almost 50. So that's like a 25% increase on no news and no improvement in business. If you look over here, the revenues in the last 2 years are actually down, and if you look at 10-year revenues, they're completely flat. So this company is not growing, and therefore I made the decision to get rid of it because I had a good return on it. I collected a lot of dividends. The price was high, so I got out of Altria. And at this point, I'm not recommending people buy it, but at $40, it's probably a great buy again. So I'll be looking to get back in at around $40, maybe $42. But this just shows you that even a stock like Altria, which is losing market share because fewer and fewer people are smoking, and during the great financial crisis, they never cut the dividends. Now let's move down this list. So Carrier is a newer company. We're not going to look at it. Actually, yeah, they weren't as a stock, they weren't around during great financial crisis. So let's look at Caterpillar. During GFC, they stopped raising dividends, but they never cut them. So these are the companies from like the middle of the pack. I'm not gonna take the highest paying dividend stocks like Verizon, like CCI, AT&T. Let's move somewhere in the middle of the pack, and that's where I got my my examples. We can also look at VLO, Valero. So close the so Caterpillar, they didn't raise the dividends during this time. I'm sorry, we're over here. They kept raising all the way into great financial crisis. Then for a year they stopped, and then they continued increasing the dividends, and now it went up from 42 cents to $1.30. That's almost threefold in 15 years. And you can see here their average dividend increase is 7.25%. So that's way ahead of inflation. And then last year they actually raised it by 8.5%. So here's Qualcomm. I'm not sure if they were paying dividends back then. Let's take a look. Yeah, they did. And actually, in a great financial crisis, they did increase their dividend. So see, it went up. Even though like the economy was going down, they did increase the dividends. And at some point, they were paying as high as 4.5% dividend yield. That was amazing. And this was a year before COVID. So that was probably the best time to buy the stock. Right now, the yield is sitting at a measly 1.5%, but over here it was 4.5%. So that was a good time to buy the stock. And that was right over here in the spring of 2019. The stock was like $56, $57, and now it's almost $200. Next, we will look at Raytheon. So their dividend increase on average 5.5%. So that's still ahead of inflation, although it's not such a great growing dividend. And last year they increased it by almost 7%, or last time they increased it. And if we look at GFC, where is that bad boy? Right here, they actually increased their dividend substantially from 20 cents to 24. Wow, that's a 20% increase during great financial crisis. Now, not all companies increased their dividends. If you look at Home Depot, I'm not sure so they kept it flat through GFC. A little bit of an increase here in 2010, but still they kept on paying dividends. And at some point, you were collecting like almost 5% yield, 4.6% yield, and right now they're sitting below 3, so almost 2.65. And but that still shows you, 2009, 2010, that was like not just for financial stocks or like stock market in general, but there was also a huge housing collapse. And still, Home Depot, which is directly exposed to housing, did not lower their dividends. During this time, they did increase it coming out of the recession, and after that, it just went through the roof. And we can see here, last 10 years, average CAGR on the dividend is almost 17%. So this year, they only increased it by 7.5%, 7.66%. However, in the last 5 years, they increased it by almost 11% per year. And over the last 10 years, they increased it by 17% per year. So this is amazing. Good job, Home Depot. And overall return on this stock is like 450%. And that's being down 2.5% today. This is amazing return for Home Depot. Now, I'm not saying you should buy it because it's like really ran up. I think it's a great buy below $300. $280, it's amazing. if we hit a major recession, guys, you got to be careful with it, because during great financial crisis, so here before it was at $40 and it dropped below $19 at the height of the great financial crisis. So buying Home Depot before a recession maybe not the best idea, because it did crash more than 50%. However, they never cut their dividends. So even if you're down on your portfolio, these companies, they continue paying their dividends. Lockheed Martin. Now, I just randomly picked those. I picked the companies that I know. So, okay, this is .com bubble. So Lockheed Martin did cut their dividends during .com, although I don't know how they're related to .com. They weren't Yahoo or anything like that, but during great financial crisis, they actually kept raising their dividend. Good job. And over here by 2013, almost 5% yield. Amazing. So not all companies increased their dividends during great financial crisis. Let's look at Valero. And Valero did reduce their dividends in a great financial crisis. So this is one of the examples where the dividends went down, and it went down substantially from like about 14 cents to 4.6 cents. So that's a 60% drop in dividend. Let's try Exxon Mobile. Now, I'll tell you, I have Exxon Mobile, and during COVID crash, they never cut the dividend. They had a huge loss of like $5 billion in one quarter, but they didn't cut the dividends. That was in 2002. They didn't raise it for a while. I mean, in 2020, they didn't raise the dividends for like a couple of years, but they never cut it during COVID, and their dividend yield went to almost 10%. That's amazing. That was the time to buy. But in the great financial crisis, they kept increasing the dividends. So ever so slightly over here between 2009 and 2010. Then next year also was a small increase, but nevertheless it went up. And remember, the oil prices really collapsed during that time. Like, they were super high right before the 2008 election, and then they collapsed when Obama was elected, and the gas was like around $2 back then. Anyway, they didn't cut the dividends, and that's something. So we can go over the companies. So Merck, another one I picked from that middle of the pile. So middle of the pile is basically their yield. Right now they're yielding around 2.5%, 2.4. Let's take a look. Yeah, so here from 2005 they didn't raise the dividend until 2012. So 7 years of no increasing in the dividends. However, they never cut them. And because the share price went down, the yield actually has increased at some point to as high as 6.5%, and now it's sitting at 2.38. So that was like 3 times higher than it is today. That means the share price was really low in 2009, but a lot of share prices like Google was amazingly cheap. Anyway, the point is that these companies did not lower the dividend, and Pepsi 2008 2009 also kept on raising the dividends. It had a more or less decent yield, but actually their yield stayed pretty consistent since 2008 financial crisis. It's not dropping unlike most other yields. So if you look over here at S&P 500, the yield on S&P 500 is going down and down and down. So that means that the underlying stocks are becoming more expensive, and the yield or dividends are not keeping up. Now, I'm not telling you to invest in S&P 500. Like, look at this. Why invest at the peak? I'm not telling you not to invest in it, because maybe it will, Tom Lee says basically will continue growing, and that today was just a minor setback. I don't know when the inflation or a recession will hit, guys. I'm not telling you when. But while looking through this list over here, I found this company Paychex. Now, I already looked at it when I did my top 10 holdings of SCHD, Schwab Dividend ETF, and I'm getting more and more interested in this company. And here's one of the reasons. First of all, they are a dividend compounding machine. They keep raising their dividends. If you look over here, 2009 they kept it flat. They never lowered it. So during great financial crisis, again, it stayed flat for a while until basically end of 2011. That was the first time they raised the dividend. So like 3 years no raises. This was probably a special dividend, but as lately, so again in 2020 COVID time, they also didn't raise the dividend, but the yield was pretty good. That means the share price was down. But in the last 4 years, they did an amazing job raising the dividend. And you can see here, over the last 10 years, they raised it by an average of 10% per year. Right here, 9.94 CAGR over the last 10 years. The last 2 years, it was even higher, 11.4%. So last year, or last time they raised it was in Q1 of this year. A couple months ago, it was again 10.11% increase in the dividend. And what's actually interesting for me is that ever since ever since basically mid 2021. So for the last 3 years, the share price is basically flat. That is amazing. It's up in the last few days, but you know, overall it's like not moving. Last 2 years, it started 2 years ago at $121, and today it's $123. So why? I'm not sure why. We can look at the revenue. The revenue is growing. Look at this. Revenue is growing amazingly, and this company has been around for a while. I like this revenue, so I'm going to do more research on this company, but I am liking this. I already noticed this company when I did that top 10 holdings in the SCHD dividend ETF, and you guys should probably watch it. I'm going to link it in this video, but take a look at the net income. It is also growing really nicely. Now there's ups and downs, but overall the trajectory is up. Now over here you can see that Q1 of each year is the highest for them, so that's probably related to tax returns. But they're not really a tax returns company. If you read the description, they provide human capital management solutions, and they provide payments, payroll processing, payroll tax administration, employee payment services, and something to do with insurance. So I'm going to do a lot more research on this company. I'm actually going to like it. You can see here, so here we have revenue by segment. They're not really buying back the shares, and I'm not sure why. Here they were actually diluting shareholders. They stopped and been kind of flat for the last 20 years essentially. So they're not buying back shares. In the last 10 years they bought back maybe 1% of their outstanding shares. Here are the analyst estimates for the company. They look pretty good, you know, like it's not a super fast growing company, but it's growing. And so these are the estimates. These are not the actual numbers, but if you look at the actual numbers, they are going up. In the last 10 years, they're growing by 7.32%. So last year, so between Q1 of, no, I think that's Q2, whatever. So May, yeah, so that's Q2 of 2021 and Q2 of 2024 and 2023. They did grow a little bit by like 5.3%, but I think they'll continue growing. Their net income is growing even faster by 8.5%, and annually, or over the last 10 years, it's growing by 10% per year. So that's really good. That means their margins are going up, and we can see over here, net profit margin was 25% 10 years ago, and today it's sitting at around 30%. So that's a pretty big increase in the net margin. The gross profit margin is amazing, 71%. PE, you know, it's a little bit higher than overall S&P 500, but I like this company. I like the growth. It's not a super fast growth, but it is growing nicely and consistently, and it is growing they're growing their dividends by a very nice percentage. CapEx is increasing slightly, but what I like about the stock-based compensation, it's basically very minimal. So you can see they have net income of $380 million in the last quarter, and stock-based compensation of about $14 million. So it's negligible, very small. And free cash flow, so it's jumping all over the place. Let's look at the free cash flow. It's still growing very nicely all over the place, but the trajectory is there. And stock-based comp is a very small percentage of free cash flow, so they have plenty of money to pay the dividends. They're paying down their debt. Their cash power is going up. So very interesting company. And again, they did not cut their dividends throughout the recession. So we can, like, there's 500 companies in this list, and we can like go through all of them. Now, sure, there were some companies that did cut dividends, and we already found one, Valero. Exxon or Exxon Mobile did not cut their dividends. But basically, going back to this price chart, again, we gotta look. So when it went from 155 to like 68 or 680, probably even lower. Let's calculate that. So we'll call it 68 divided by 155. So it went down by 56% from the top. Okay, from over here to over here, that's 56%. It's a huge decrease, but the dividends overall did not suffer so tremendously and quickly recovered and went up. And by the time 2012 rolled in, they were back to the highest level from the top. So basically, if you want to survive the recession, dividends is one of the most effective ways to do so. Now, I'm not saying to invest in S&P 500 because not every company in S&P 500 is great. For example, MMM or 3M just did a massive dividend increase, and that's after being a dividend king. They were raising their dividends for 50 years, and here they cut it finally. Now, this was a special dividend because they spun off a company, so they paid out the dividend. But prior to this, here they were raising their dividends all the time, and even throughout the financial crisis, they did not cut it. They were raising it, but here they basically raised it by 1 penny just to keep the appearance of increasing dividends, and finally they cut it by more than half. So that's not a good example. However, there are many good companies in S&P 500, a lot of good dividend payers, and they many of them do not cut dividends, so you can build your own portfolio. I would actually love to compare SCHD. I just did a video about them paying their highest dividend ever, but unfortunately they were not around during great financial crisis, so we have no data. You see, they were created in 2011 when the great financial crisis was basically over, so unfortunately we can't see that, and there weren't other great dividend ETFs during that time. However, these companies are all about dividends, okay? The companies on this list, and the criteria of a CHD is to pick companies that have raised their dividend. Well, actually, I won't say that. It's better that you just go and read the prospectus on how they select companies, but basically they do a very thorough vetting before adding companies to this ETF, and they're all dividend payers. So if you're looking to survive the recession, if we're going to have one, and probably we will, then dividend portfolio is one of the best ways to do so, because while the share price will likely drop, like you can see over here, it dropped in October of 2022 during that market bottom when S&P 500 was basically like 3600. Now it's 56. So it went up by 2,000 points since then. And then also over here, when we had the October drop, it went down to like $68. So the price of SCHG might go down, but the dividends, they do not cut the dividends because they collect dividends from the underlying stocks and they distribute that to the shareholders. And so what happens here, when the price drops, and if you reinvest dividends, you actually acquire more shares on sale at a cheaper price, and then you enjoy the better yield going forward. So yeah, basically one of the good ways to kind of go over recession without losing your shirt, without selling off your 401k or your retirement portfolio, is to have dividend stocks, and those usually do not get cut, or they get cut much less than the drop in the share prices of the stocks. So guys, thanks for watching. This was Leo with DRIPCalc.com, and if you enjoyed this video, please smash that like button, subscribe to the channel, and also if you want to try out the software I'm using right here, which gives you visual revenue and earnings data and dividends and all kinds of other stock information, then we are running a summer promotion, 30% off lifetime for all the subscribers from this channel, from this YouTube channel, and you will get that for life. So when we increase the price, your price will not change. And if you want to try it, we offer a 2-week trial, so you can try it now. If you don't like it, just cancel, and you will not be charged. So with that said, thanks for watching. I'll see you in the next